Hello, everyone. My name is Pierre Villery, and on behalf of my EastGroup Analysis team, Jason Costa, Richie Gray, Johanna Casper, and Eric McDonald, I would like to welcome you all to the EastGroup video report. What is EastGroup? Well, here's a picture of one of their properties. This property is at the World Houston Complex directly adjacent to the Bush International Airport. EastGroup is an equity real estate investment trust that develops, acquires, and operates industrial properties in major Sunbelt markets throughout the United States. Their focus is primarily in Florida, Texas, Arizona, and California, but expansion plans are in the works for North Carolina. The company's headquarters are in Jackson, Mississippi. Currently, the company has 28.1 million square feet of property under management. EastGroup, led by David Hoster, believes in a conservative philosophy. They manage a strong balance sheet and only make investments in projects they believe will fit the strategy of providing extremely attractive returns. EastGroup is proud to boast that at the end of 2010, it paid out its 124th consecutive quarterly cash dividend and its 18th year without a reduction in the dividend. EastGroup stock ticker symbol is EGP and is traded on the New York Stock Exchange. Here, you will see a 5-year chart with EastGroup stock price. Notice the plunge during the financial crisis of 2008. Its consistent dividend payments and conservative strategy are key components in driving the stock's price recovery. In 2010, EastGroup started developments in San Antonio and Houston. EastGroup also finished development on 5 properties in Arizona, Florida, and Texas. EastGroup acquired properties in Charlotte, San Diego, and Phoenix in the same year. EastGroup believes the Charlotte market could be a key driver of revenue growth given the demographics and population and economic growth in the Charlotte area. EastGroup was hurt during the financial crisis, especially in Florida, because many tenants were related to the housing industry. EastGroup's operational risk lies in its ability to lease out its available space. As the economy rebounds, we expect EastGroup to begin filling unused space. EastGroup is subject to some environmental risks, such as bad weather. In Florida, its insurance policy changed from having to pay a deductible for one property to having to pay a deductible for each building in a complex that was damaged. We do not expect regulatory risks to affect EastGroup, and we expect EastGroup to be able to meet all financial obligations in the short and long term. Interest rates are very low right now, and we do expect the Fed to try and raise these interest rates in the next 12 months. This could affect the cost of borrowing. However, EastGroup's conservative approach means that it will only borrow to invest in the projects that present the highest return. EastGroup is in a strong position compared to its peers. We found their main competitors to be A&B, First Industrial, and DCT Industrial. We'd like to point out 2 important numbers. Debt-to-equity ratio. Compared to its peers, EastGroup has one of the lowest debt-to-equity ratios. In fact, First Industrial and DCT both have debt-to-equity ratios over 100%. In EastGroup's case, it is only 62%. Finally, we'd like to show its return on equity. EastGroup outpaces its peers by a significant margin. While EastGroup has a return on equity of about 4.5%, A&B, First Industrial, and DCT all have negative ROEs. The impending A&B Prologis merger will radically expand A&B's current capacity and resources, which will likely place the company in a new peer group into the coming year. The overwhelming majority of EastGroup's shareholders are investment managers, followed by brokerage firms, strategic entities, and insiders. As a group, company insiders hold the lowest percentage of shares. EastGroup's top 10 investors are investment managers, and they have changed very little over the last few years. EastGroup's top 10 investors own about 52% of the shares, owning a majority of the company's shares. In our analysis of EastGroup, we traveled to the company's headquarters in Jackson, Mississippi. We met with CEO David Hoster, CFO Keith McKee, Controller Bruce Corcoran, and Board Chairman Leland Speed. They told us about their strategies, their conservative approach to running the company, how they take pride in every property they own, and how not to let success go to your head. Pictured here is our analyst team, along with Mr. Hoster and Mr. McKee. EastGroup seeks to maximize shareholder value and is poised for conservative growth during the ongoing recovery. We expect the company to grow revenues through expansion opportunities in key Sunbelt markets. Currently, the company is expanding its Arion property in San Antonio and its World Houston property in Houston. The company's conservative approach is a good strategy during the recovery, as occupancy rates will not support massive expansion in the next 12 to 24 months. Because EastGroup has vacancies, we expect the company to fill those vacancies with a more diversified set of clients, protecting it against future economic risk. Once the company is able to reach occupancy rates of 93%, EastGroup can raise rental rates. Combining increased occupancy rates and increased rental rates means revenue growth for EastGroup. EastGroup is not changing their strategy of focusing on the Sunbelt, but they are expanding outside their traditional markets to grow revenue. One example is their new development in Charlotte, North Carolina. We have mentioned management's conservative approach many times, but we believe it is one of EastGroup's core strengths and is of great value. We only expect management to enter into smart development projects. Finally, management firmly believes in delivering quarterly cash dividends. While many of EastGroup's peers cut their cash dividends or canceled them outright during the economic downturn, EastGroup's management maintained its dividends without cutting them, and they would not have been able to do this if it weren't for their conservative approach. We also expect the company to increase dividend payments in the next 12 to 24 months. To get our 12-month target price, we use 3 valuation methods. First, we used price to funds from operations. Because REITs pay dividends, FFO is commonly used in analysis. We also used enterprise value to EBITDA and net asset value per share. Combining these valuation methods, we estimate EastGroup stock price will be $46.75 per share. Compared to the stock price on the report date, March 31st, we give EastGroup stock a market perform rating. Here are some further fundamentals behind our analysis. If our 12-month stock price is realized on March 31st, an investor can expect an implied total rate of return of 11.05%, leading to our rating of market perform. On behalf of the EastGroup analysis team here at Burkenroad Reports, we would like to thank you for watching this video. And to please the lawyers, I will read the following. The Burkenroad Reports are produced solely as part of an educational program of Tulane University's A.B. Freeman School of Business. The reports are not investment advice, and you should not and may not rely on them in making any investment decision. You should consult an investment professional and/or conduct your own primary research regarding any potential investment. Again, thank you.